Okay, online. Hello, good evening, everyone. Can someone say something? Can you hear me?
Good evening, sir.
Okay, good evening, sir.
Yeah.
I can
Okay,
hear you
so,
clearly, sir.
all right. So it means we can start immediately as well. So let me just try to share my screen first before we, let me just, so this should be fourth webinar that we are going to have in this year. We started from January. We've done the one of January. We've done the one of February, and this is March. Though we started since last year. So this is third one now. And then before we move to the next one. So today we'll be looking at working capital management and cash flow analysis. And this aspect is mainly talking about IAS7. IAS7 is talking about cash flow statements. So tonight we also be looking at cash flow statements, just very briefly. So it won't be like what you are expecting in ICANN exam anyway, but it's going to be a bit deeper because we will not be solving any question. So all we'll just be doing is just to analyze, just to look at it and how do we manage our cash flow. Okay, so without wasting our time, my name is James Olashore, and then the learning objective will be to explain working capital management, to analyze how to unlock or release cash into a business. So this one will also help you, either you are working in an organization or your own personal business. Number 3, analyze the levers that influence working capitals or working capital and cash flow performance. Then we also look at analysis or analyze data sets of a company to quantify improvement potentials. Number 5, we also look at or we identify process and policy improvement opportunities. And lastly, we will discuss initiative and then set improvement targets for us to achieve those areas. Okay, so before I go on, let me first discuss what we call cash flow statements. And from cash flow statements, we'll be able to look at working capital, because working capital is like a subset in IAS7, which is cash flow statements. So we'll be looking at the whole cash flow first. And don't forget, the cash flow is either you use direct method or indirect method. So whatever way you are using, you are good to go. But cash flow is just part of the components or part of the financial statements. So when we're talking about financial statement, we're talking about statement of financial position. We are talking about income statements. We are talking about cash flow statements. We are talking about note to the account. We are also talking about other information that you need to disclose. Sorry, I'm trying to get a particular document. That is why you can see me. I'm not that flowing for now. So now, from cash flow, I want to try to share a particular document so that we'll not be looking at cash flow from just from our end. So cash flow is divided into 3 parts. Like you all know, if you are using either direct or indirect method, we are going to have operating activities. We will have investing activities. We will also have financing activities. So this aspect we are talking about today is mainly we are to stop under investing activities. Under operating activities, sorry. And under these operating activities you are talking about, we'll be having the working capital under it. So I'm trying to share the document so that we'll be fine to go together. I think I'm good to go now. So let me share the document with you. Let me stop sharing this and pick another one. Okay, I want to believe you can all see my screen now. Yes, so we are good to go now. No more wasting of our time. So this is what we call cash flow statement, in case you have not seen it before. And this cash flow statement, you can see that it's separated into 3 segments. We have operating or operations, we have investment, and we also have an aspect we call financing aspect. So we have the aspect that is financing aspect. So our focus today is going to be on only operation. And this type of cash flow you are seeing here is majorly direct method. So either you use direct method or use indirect method, you will still find your working capital. So you can see we are having revenue, we are having other proceeds and the like. When you are using direct method, that is when you are going to be calculating what you receive from the suppliers, from the sales, whatever you receive as your income or revenue for the year, then payment to suppliers. You're also going to calculate that. Then from payment to suppliers and what you receive from the customers is what is going to form the part of working capital we are talking about. But when you are using your indirect method, that is when you are going to start with profits for the year. That is the operating and the profits you have. Then you add back your depreciation, that is all non-cash items and the likes. Then after you have adjusted all non-cash items, that is when you are going to have what we call the working capital. So working capital is divided into majorly, the components majorly is 3. So you are going to have your inventory, you are going to talk about payables, you are going to talk about receivables. And those are the 3 aspects we want to focus tonight. And that is why I'm trying to show you this working cap, this IAS7, which is cash flow, so that you will know that we actually have more than what we want to discuss in cash flow. But because we only choose to talk about 3 items, which is receivables, which is inventory, and which is payables. Those 3 is what we call the working capital. Okay? So I believe we are good with that. So I can unshare this. And what are the makeup of the working capital? So by the time we get there, we will know what to do. So I believe I've been able to introduce it properly. Let's go back to our normal slide now. And let's kick off from there. So as we move on, if you have any question, don't hesitate to throw it. It's either you share it in the chat box or you unmute yourself and you ask your question. Okay. Now, first of all, what is working capital? Working capital is the cash a company has tied up in current assets, less the cash it owes as a current liability. In a nutshell, we are looking at our current assets and we are looking at our current liability. And we are netting the two. Whatever we have as a difference is what we are talking about as our what? As our working capital. And that is why when you are calculating your cash flow, whatever you have in your balance sheet or in your statement of financial position as your cash balance must be equal to what you are going to have in your cash flow statements as your balance. That is when you are going to know if what you have done is right or wrong. If what you have done is agreed or not. So now when we are looking at these working capitals now, we can see that we have divided the items we can see under the current asset. Under current asset, we can have cash, we can have marketable products if you are into selling of products, whatever you can sell to turn into cash. Then we call that one the marketable products. Maybe you have your inventory. Audio issue. What happened to the audio? Can anyone talk to me? Can we all hear me? Without
Yes,
any
we can hear you, sir.
Okay, maybe it's
Yes,
from
we can
his
hear
side.
you.
Okay, so maybe it's from his own side. So there's no audio issue here. Okay, so we have items under current assets. So when you look at, okay, fine, I can hear you clearly. So when you look at your current asset, we have cash, we have marketable, we have security and investment. This investment we are talking about, they are the short-term investments that you can easily turn into what? Into cash. Then we also have your inventory. Inventory is also part of current assets. Then when we are talking about the other aspects, which is the current liability, we talk about accounts payable. We have about accrued expenses. We have payables, normal payable. We have portion of liability that is meant to be paid in that current year. For example, maybe you have a loan from bank that is going to last for 5 years. So you're supposed to, every year, you're supposed to be separating that loan into current and non-current. Because the one you are going to pay in that year is going to be a current liability. Maybe you are paying at the end of December, at the end of every year or of accounting year, probably maybe December. So you are going to separate the one you are going to pay in that December as a current liability. Then the one you are going to pay, the balance you are going to pay in the remaining 4 years will be on the non-current liability. Okay, so that part will form the part of our working capital. Now, what are the things that drives the working capital performance? One, we have what we call external factors, and we also have what we call the strategic factors. So when we are talking about external factors, we are talking about the strength in value chain. That is the follower and the leaders. Then we also talk about the extensive and the limited. We are going to be discussing all this one as we move on. Then the strategic factor we are talking about, it can be either vertical integration or we talk about the horizontal integration. Then we can also talk about the geographic footprints, which is international or domestic. We can talk about the product mix, which is the product and services, or we can talk about the product's complexity and you make it simple. All this big grammar will be dismantle it as we move forward in the webinar. Now, the first one to talk about, let's talk about the internal factors. When we are talking about internal factor here, we are talking about the payables, inventory, receivables. And addition of these three will give us working capital. But we can actually have other things apart from these three things we have here. We can have more than payables, but this payable we are talking about is they are still payable anyway, but we can actually separate them. Is it network? Sorry, can you still hear me? Sorry, the network was so bad. Can you confirm if you can hear me? Sorry.
I can hear you.
I can hear you.
Okay, sorry. So the network was a bit bad there. So let's continue from where we stopped. Okay. Okay, so let's continue. From where we stopped, we are still talking about the we are still talking about internal factors. We are still talking about internal factors. So I said we can actually have more than this payable you are just seeing. Because sometimes if you just look at your financial statement and you see only payables, you'll not be wondering if you see other things there. Am I going to include this other payable or other thing I want to pay, anything liability as part of my cash flow under working capital? So anything you recognize as working capital, anything you put under your current asset should be recognized as part of your under this current asset. Then anything you put as your current liability should be part of this payable we are talking about. That's why I have to break it down here. The cash, the marketable, security, investment, inventory, all these are part of your current assets. Then when you are talking about payable, accrue expenses, even under the current asset, we still have what we call prepayment, which is still part of this current assets we are talking about. Okay, so without going or wasting our time here, let's look at what we need to do. Now, under here, we have what we call policy. And if you see the policy, you will see that we have source, contract, procure, receive, process invoices, manage disputes, and then the payments. Don't forget, the topic we are actually treating is not IAS7. It's just a subset, which is the working capital. So we are looking at it to manage your payable. What is the best way of doing that? What is the best way to manage your payable? And the first thing to do here is you want to buy something, you have to source. Your company wants to buy a particular product. Your company wants to buy inventories. You have to sort for what? You want to sort for the person that's going to supply you. Why do you need to sort? Because you want to make sure that what they are going to supply you is the best, is the good quality, is the standard quality that you need in that production. That is one of the ways to control your working capital. Another one is the contract. Once you now see someone that is going to supply this particular material, the next thing to do is to know who you are going to choose to supply. In that first part is to source, is to compare quotes. Company A is giving me 50,000. Company B is giving me 60,000. Who am I going to go for? Then from there, you now contract. Pick one of them to supply you this particular product. So once you pick the one to supply, then you buy from them. That is the procure aspect. When you order for it and you procure, they will bring the goods to you and you put them in your inventory. Then when they bring the goods, at the beginning, you are not going to see the invoice. They will give you pro forma invoice or they will give you quotation. Then when you receive your good, they will supply the invoice that, yes, so since the good is now with you, Mr. Man, pay our money. That's when the process invoice. Okay, if there's a difference between that invoice supplied and what you have agreed initially, what do? You make sure you correct the debt. Who is going to be blamed and what are we need to do? From that aspect, you are good to go. That is for that aspect. Now, you make payments. The payment aspect, which is the last part, is now where the management is coming from. And what does that mean? When you are paying your supplier, when you purchase and you are paying your supplier, are you paying early or you are paying late? If there are agreements between you and between the supplier and you is 20 days, and you are able to delay the payment to 30 days, my brother, you have done a good job because you have positively affected your working capital. The more you delay the payment of your supplier, the better you have done because you have been able to hold their money to run your company, to run your activities. Though there are some negative parts of that may damage the organization reputation. They say, this company that doesn't pay on time, or it may also affect the supplier from giving you the particular product request for. But if you can continuously manage that aspect, you are doing a good job because you are able to hold the money supposed to pay to supplier longer than the period stipulated. Now, when you are talking about inventory is just the opposite of payables. Inventory is talking about how long it's going to take you to convert the raw material into what? Into finished goods. How long does it take you? You bought a particular material today. Maybe you are into production of particular product and you have bought raw material. How long does it take you to turn that raw material into what? Into finished products? The longer it takes you to convert it, then the worse you are doing. You should be able to do that within few days. If you convert your inventory within 10 days, and another company is converting their inventory into finished products in the 20 days, you are doing better than them because you are able to convert your inventory in time so that you can get cash. That is where the working capital is coming from. The same thing to the receivable aspect. But before we go, let's look at the inventory aspect there. We have the product range, we have the forecast, we have plan material, schedule production, manage inventory. You must know the reorder level. Not when your inventory is remaining 5 units. That will not be enough to work for that day. You now start calling and start disturbing. No, 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 no. You must know your reorder level. What is our reorder level? Before you can actually decide to say, yes, we are managing our inventory properly. Process order. How long does it take you to process the order? 5 days, 1 hour, 1 day, 1 week. So you must make sure you factor all these processes when you are dealing with the inventory. Then we also have the other one, which is the receivables. We all know that receivable will not appear, will not occur if there's no credit sale. And you get your receivable from the sales you made. So the first process is to sell. When you sell, it now depends if you sell on credits or you sell on what? In cash. Then we look at the order entry. We look at the billing. We look at the collection. And we look at the disputes. And we look at the payments. Where we have to focus here is the credit sales and the collections of that credit sales. That is what is going to positively affect affect our working capital. So maybe you have 1,000 products and you sold all the products for credit. You are not doing fine. That is very, very bad working capital. Because what happens if these people refuse to pay you? How will you continue to run your business? Okay? Now, let's assume that you produce 1,000, you are able to sell 80,000. 20,000 is outside. I mean, you produce 1,000, you sold 800 for cash. You sold and you collect your cash immediately, 800 out of it. The remaining 200 units is on credit. Fine. You must be able to know how many days am I targeting to get my money back into my working capital. The longer the period the receivable is staying outside, then the bad, or how will I put it, you are doing in that business. You are not doing fine in that business. You must make sure you collected, or you receive your receivable. You get back your receivable into the organization, into your working capitals to run that particular organization. So now, in a nutshell, payable, the longer period you delay it, the better you are doing. Inventory, the earlier you can convert your inventory into finished products, the better you are doing. The receivable, the shorter you can receive your receivable, the credit sales from people that hold you, that are owing you, the better you are doing. In a nutshell. Let's continue without wasting our time on that. But because that is the key area, that's why I have to spend more time in that particular aspect. Okay. Let's quickly ask ourselves these questions. If you can answer this question perfectly, and you can have yes, 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 or not sure, it means you are doing a better. So if you want to evaluate your company, you want to know if your company is doing fine in working capital or not, just ask this simple question and tick if it is yes or no or not sure. Now, the first one is uncertain or unpredictable business environment and trend. If your answer here is yes, it means you are not doing, you are on the on the red wire, the naked wire. Okay, if you cannot predict that I'm selling 1,000 units, if you don't even know how to predict your business environment, the trend. You don't know in the next year, we should be able to sell 1,000 units of our products. So it means we won't be able to prepare budgets. And if you are unable to prepare budgets, you won't be able to forecast. If you're unable to forecast, you'll be able to model. Look at the future, what is likely to happen in the future. So if you don't have trend for your working capitals, then it means you are not doing fine. Insufficient cash on hand to fund acquisition and CapEx. The CapEx here project is meaning capital expenditure. So if you don't have enough cash to run your capital, because the fixed, the non-current assets should cover the non-current liability. If you have borrowed money from bank like 1 billion naira, and you now use that 1 billion naira, you injected that 1 billion naira in your current assets. My brother, my sister, you have done very, very bad. And you are going to pay that 1 billion naira for 5 years. And you now injected that 1 billion naira in your working capital and in your current assets. You have done something very bad to that organization. The truth is that your non-current liabilities. Just a minute, please. Okay. So what we're saying is that your non-current liability should finance your non-current assets. If you have gone to bank to borrow 1 billion naira from bank, you should invest that 1 billion naira in a particular asset that is going to last for 5 years at least, so that whatever proceeds, whatever return you are getting from there, you will use it to run the loan, repayments, and the interest. That is how it should be. Then your current liability, probably the payable, probably overdraft, you also finance your current assets. So you cannot get loan that is going to that you are going to pay in 1 year and go and invest that particular loan in a long current asset that will last for like 10 years before you can start generating money from it. The person will run into debt or bankrupt because you won't be able to pay back that loan or interest. Okay? Increasing vulnerability of the market downturn. Then we also have weak negotiation position in the capital market. When you are unable to negotiate, when you are unable to negotiate in the market, then it becomes a problem. Because whatever figure they give you, that's what you are going to pay. So it becomes a problem. Then we also have little understanding of acquired business cash position. When you don't know how much we have, then what the cash you have also should not be as that too much. Some people will have like a 1 billion naira in your account. You have 100 million in your account. What are you doing with all those cash in your bank? You're only giving the bank to use your money to run their business. Why will you be having 100 million in your account and you are still struggling? You're having 100 million in your account, you're having like a 200 million in your account. When you can actually turn that money you are holding in your bank account into something meaningful that will continue to generate inflow for you. I hope we are jotting all this. So the level of cash you have in your bank account will also affect your working capital. The day you will receive your your receivables, your credit sales will also affect your what? Your working capital. how long it take you, or it's going to take you to convert your inventory into finished products, will also affect your working capital. Then how long you pay your debts. If you pay early, you are doing badly. But if you are able to hold their money to run your business for like a few days, you are doing fine. Okay, let's continue. Dissatisfied suppliers. When your suppliers are dissatisfied, is a dangerous aspect, because when your supplier are dissatisfied, it's likely to affect your working capital. However, that dissatisfied we are talking about depends if, as a result of holding this cash with you. So you can just play your game very well, hold it, but not too long. If they're not complaining, try to hold it so that you can try to manage your working capital. Increasing customer payment default. When your customer are owing you more than necessary. Before, a particular customer used to owe you within 30 days, they will pay. But now, this customer is now owing you for more than 30 days. It's going like a 40 days before they pay you. You know that you are not managing your working capitals properly. Then, lack of visibility and control over working capital requirements. So just sit down yourself and answer all these questions, either yes or no, or you put not sure. If you are not sure, put not sure. So if you are not sure of this answer, it means you don't know your company very well, or you don't know yourself properly. So you have to see that your answer is supposed to be either yes or no. So if you're not sure at this time, it means you need to go and do more research to know what should be your answer. Having said that, now let's move a bit forward. Now we come to working capital management development journey. How do we assess the sustainability execution? How do we make sure? I think I have a question. If I have a question, if you have any question, please just drop it. How do we get the templates? Okay, which templates are? Okay, the one I just explained now. Okay, I will share the templates. I will share the templates so that you'll be able to evaluate yourself. Either your answer is yes or your answer is no. Okay, so let's go to assessment to sustainable execution. Now, the first thing to look at is data extraction and cleaning. Before you can calculate your working capital, it's going to take so much time, because you are going to break down all your working capitals, especially your payables. You are going to know, for example, a company that has like 1,000 customers.
Discuss this question.
Please mute your mic if you are not talking. Mr. Let me try to mute everybody so that we will not disturb each other. Okay, thank you. So, data extraction and cleaning. So, a company might have like 1,000 customers, and you need to know how much each of these customers are owing you, and what is their payment period, days. How long does it take them to pay back to us? You need to analyze them one by one. You can also use ratio analysis to calculate payable. We also call it efficiency ratios or working capital. So to calculate that, we all know what to do. The formula you are going to include, if you are working on the payables, you are going to be looking at the payable and the cost of sales or purchases multiplied by 365 days. Then if you are talking about receivables, we'll be talking about the receivables. You look at the credit sales or receivable if there's no credit sales in the question. Then sales or revenue will also be in the calculation, multiply by what? you multiply it by 365 days. And from then you will know how long it's going to take them to pay back to you. And you will know if you are doing fine or you are doing badly. Now, so the one aspect is the journey, the one aspect is the data extraction. To get all this data will be cumbersome sometimes. But if you can take your time to do all that, you are fine to go. So focus analysis. So deep dive analysis into accounts payable, receivable, and inventory to get all these data will be a bit tasky, but if you can do it, it's going to be very helpful. The next one is high impact insights. Action of analysis and development of prioritizing framework that drives short-term action items. So you look at it, which one is going to be in short term? Because when you're looking about working capital, we are not talking about something that is going to last for like 2 years or 3 years. We are talking about what you use to run the business, day-to-day business activities. Within a day or within a week, maximum. Even that 1 month is too long. Within days and week, how much is coming in? How much is going on? How much are you putting back into business to run it again? And this also applies to our individual. Some people, when most of maybe our sisters or our wives, when you give them like 1 million to start a business, some of them, when you ask them in the next 1 year, that 1 million naira will have deteriorated to like 500,000. And if you ask them where is the remaining balance, maybe they are selling it on credit to their friends and the likes, and they are unable to get it back. But those who are very good among them, those who know how to manage the business, by the time you ask them in next 1 year, you will see that that money will have been what? Multiplied, because they are able to manage the working capital and they are able to put back to the business. Then we look at the execution of short term. I think I don't want to waste much time here. Digital strategies, activation, and roadmap, and the like. So I have a particular workings we are going to do. I'm going to show you when I get there. So I have a particular workings. I'm going to share Excel, and we look at it together how it has to be. Then we have the capacity and planning and the like. Now, diagnostic engagement with stakeholders interaction. The management-led transformation with special support in key areas such as procurement, change management, system implementation, supply chain optimization. So if you are an accountant in this webinar, or you are a business owner, that is, you are talking about the working capital of yourself, or you are representing a particular company, maybe you are a CFO or you are an accountant or whatever. Here, there are some policies. There are some things you are going to lay down for you to achieve all these working capital. So the first one is you need support from the management. Because if you design policy, people or your fellow staff may not follow that particular, they may not agree with you. They may say your own is too much or whatever. But when the managements are backing you up, whatever plan you lay down as a policy, I bet you they will all agree with you. They will all follow you. They will all support you, because they know that if they fail to follow, there's going to be sanction on that. Okay, so for you to achieve all this working capital we are talking about, for you to prepare or create a policy that's going to be possible. What type of policy am I talking about? Example of that policy is that, see, our receivable must be collected in the next 10 days. Anytime we sell to our customers, we must make sure we receive our money within 10 days. Whatever we buy, we are not paying immediately, or we pay 70% immediately. The 30% must be held for 30 days or must be held for 20 days. These are the policy we are talking about. And you, as an accountant, you can't do this one yourself. You need backup of the management so that whatever you say, they will say, yes, that is what we want now. Then your procurement, you must make sure you are not just buying. You are just buying. You just buy. You go to some people's organization store. You will see their store will be full, loaded. Either they need it now or they need it in the next 4 years. They need it now or they need it in the next 2 months. They are just buying. No reorder level. They don't know when to buy new one. They don't know when to stop buying. They just buy, waste money. They will now have enough inventory in their store without turning that inventory into what? Into finished goods. So they are tying down money in the current assets for too long without recouping it into the organization. And it's affecting their working capital. You see them keep struggling. Go to their store. They are having over 50 million inventory. They are having over 1 billion inventory there, and they are not selling it. And if they are going to finish that 1 billion inventory or 50 million inventory, it's going to take them like 1 year before they can turn that inventory into finished good. And it's affecting them working capital. All these things are what we need to look at. I think I have a question. Okay, you are dropping your email. Don't worry, I'm going to share this. Okay, so we also have change management. There are some management that you just have to change. They are not ready to comply. They are not ready to help your working capital. They are not following the policy you have laid down. Then system implementation, supply chain optimization. When you are talking about supply chain, we are talking about from buying it to production to selling. Okay, you buy. This supply chain we are still talking about is still within that 3 payables, receivable, and inventory. You go to the market, you buy. After you buy, you turn it. After turning it, it's ready to be sold. You sold to the customers. You receive your money. The money you receive, you take it to the market again to buy the product. You bring it to inventory. You turn the inventory to receivable. Receivable again. You collect your money. You take it to the market again. That is how it continues over the years. Okay, that is how it continues over the year. If you drop your email here, I may not be able to get them. I will advise that you send them on the platform or anywhere you see this link. Just drop it there. I will pick it up from there because I may not be able to get all this email for now. Now, finally, before we move away from this stage, because I don't want to stay too long on this webinar. Effective working capital management improves a company cash conversion, efficiency, and operating cash flow. This, in turn, supports strategic capital allocation goals to fund CapEx. When we say CapEx, we're talking about capital expenditure, acquisition. Maybe you want to acquire another company. You have enough money to acquire them. Then dividends. You will have enough things to share to shareholders. Share buybacks. Maybe when you needed your money, you use share option. You invited people to come and buy share from you, and they pay you money so that you use that money to run the business. And now you don't want them to be part of your organization again. I mean, part of your shareholders again. So you are buying the share from them. That is share buyback. You back from them so that they won't be part of your shareholders again. For those who want, and that's in that process, you must have put that option that you are likely to buy the share back from them. Then debt reduction. Let's move away from here so that we will not waste our time. If you have any question, let me know so that we'll be able to treat that. Okay, what are the focus on the key levers to improving our working capital? So how do we improve our working capital? We have supply performance, inventory management, we have demand variability, procurement strategy, terms versus industry norms, terms trigger points, contract versus system invoice, then payments run frequency, early payments, invoice consolidation, and rebate structure. Now, this webinar, I'm not actually talking about IAS7. I'm just trying to refer to the standard that talks about the working capital. If I really want to talk about IAS7, this time will not be enough for us, because IAS7 is very, very interesting and wide. But this one is just a subset of IAS7, which is very vital. Now, to manage our working capital, the key factors we must focus on is the supplier performance. In what sense? Will the supplier will be able to give us what we need when we require for it? We need 20,000 units. The supplier we are getting from them, when we need it, are they going to supply us? Because we know that if we need 20,000 units and we are unable to get that 20,000 units, it will definitely affect our products we are going to sell. And if it affects our products we are going to produce, it will go to affect our products we are going to produce. And if it affects our products we are going to produce, it will definitely affect the products we are going to sell. We won't be able to meet up with our customer. If we are unable to meet up with our customer will look for another person that can give them the units they need. And from there, we are losing customer. And the revenue is not actually coming in as we expected. Are we getting that gist now? Then the next one is inventory management. How do we manage our inventory? Do we know our reorder level? Do we know when we're supposed to reorder and stuff like that? I think I've discussed about that. How do you manage your inventory? Do you have damage, obsolete? How do you arrange them? How do you separate them? How do you value your inventory? FIFO or LIFO or weighted average? Which one is more acceptable? And how do you cost all this inventory into your financial statement? I hope my screen is moving. My people, can you confirm? Is the screen moving? Are we on the same page? Can you see my screen that the screen is moving? Can anyone confirm that, please? I hope my screen is moving.
Sir, your screen is not moving, sir.
Oh,
We are seeing the screen on when can you how can you determine the benefit of working capital and
It's
asset
not
management?
moving.
I noticed that now. Okay, so my screen is not moving. So sorry about that. Let me share that again. Let me reshare that. I just noticed that the screen is not moving. Can you see a new screen now? How do we define working capital, Abi? Fine. I think I can see that now. Okay, so you can see the blue where I am now, Abi. I believe you can see that now. Can we please confirm now? Okay, I think someone is saying something. No, sir. Can we now see it now?
Yes, sir. Yes, sir.
Focus on the key level. Okay, so fine. Thank you so much. So let's continue now. Okay, so we have demand variability. Will you be able to meet your demand from the customer? Okay, then procurement strategy. How do you strategize of the procurement? How do you make sure you are not buying the high price? How are you sure that you are buying the lower price with good quality? Okay. Then we also have what we call terms versus industry norms. There are some things that they look at it as a norms in industry. How will you expect me to pay you immediately when I buy. At least people are buying. Nigeria is owing. Is also owing. This thing is also owing. China is owing. So you must make sure you you separate norms from your terms and conditions. They will shout, he cannot say 10 days, so we cannot pay you 10 days. We cannot give you, you have to pay me within 10 days. You must make sure that is our own standard here. You cannot be expecting us to buy your goods and give you cash immediately. Or I want to do something for you. You will not pay me 70. You will pay me 30 later. No, this is our own policy. They must know that. That is how you can improve your working capital. Then the next thing is contract by my left. I'm reading from my left hand here, my left side here. So we have contract versus system invoice. How do you want to create your system invoice? Is it this invoice you are doing manually that it is very easy for people to maneuver, or you are generating directly from the system? The invoice is going to your supplier, your customer are paying through invoice and stuff like that. Payment run frequency. When do you make your payment? I think I've explained that. Do you pay immediately and the like? Early payment. So early payment is good if you are the company because you receive your payment on time. Invoice consolidation rebate structure. If you notice that some people don't always pay on time when you say to them, you can introduce rebate structure. That is, if you are able to pay within so period, there's a discount of 5%. Many companies, they are doing that. So if you buy 1 million product from me, and if you can pay within 5 days, you are going to pay less 5% from that your payment. That is another strategy. You are getting your money on time. You are putting that money back to your organization, to your working capital, to run the business. Okay? Then we also have what we call the other side now, which is the right hand side. We have credit note. We have speed frequency. We also have payment receive method. How do you receive your payment? Is it through cash? Please, what is the meaning of CFFO? Cash flow from operations and cash flow, free cash flow. How is it calculated and different between the two? Okay, so don't worry. I'm going to come back to the question as we move. Okay, so we have payments receive method. How do you receive your payment? Is it through cash or through transfer or through credit? Collection policy, dispute resolution, risk management. You must also be able to look at the risk aspect. This person I want to buy product from me and is going to pay in the next 10 days. You evaluate the person. Will the person be able to pay in the next 10 days? Or my money will be at risk? Is also part of working capital management. Ability to know if you'll be able to get your money back within the short period. Okay? Taxes. What are the taxes that are attached to a particular transaction? You must know that one. Tax planning. If I go this way, am I going to pay more tax? If I go this way, am I going to pay more tax? That's also payable. Real estate strategy, matrix, and then reporting, policy and adherence. You must make sure you make policy and they obey it. Not that you say they must not sell my product. The people must pay my money within 30 days. And some of the customer are yet to pay in 60 days. And you didn't say anything about it. You didn't sanction those who sold that good on credit without getting it in 60 days. You just leave them. It means they will continue to do whatever they like. Then you must also train your staff. You must make sure they attend training, either ICANN training or accounting training. The more the training they go to, the better they will be able to deliver in your organization. That's just the bitter truth about it. If you are not going for training for almost 2 years an accountant, you are not attending any training, it's what you know almost 10 years ago. It's the same thing you are using for that business. And the business is changing over and over. It means you are the one running the business down. Because you are not updating yourself to know what are the new things I should put in place to assist this organization, especially now that the whole thing in the country, in the continent, is very, very worse. The economy is down. You must make sure you attend seminar, training, update yourself on how and what you need to do to make sure that your company is on what is surviving at this very point. And one of the most aspects is working capital. If any investor wants to invest in a particular organization, the first thing you need to do is to go to their cash flow statement. And you are going to see all their secrets there in short time. If I want to invest in a particular organization, just go straight to their working capital, to their cash flow. You will see their naked wire there. Before you enter into that organization and start putting your money there, you will know if within few days you won't be able to survive or you can survive it. Without wasting our time, let's move on. The next aspect here is the working capital management. Okay, so the working capital management methodology and tools. What are the tools we can use in working capital management? One is working capital benchmarking. So you can look at the historical trends in working capital. In year one, maybe you want to prepare your working capital for this year. You can look at what you have been doing for previous year, like 2022, 2023, and the likes, so that you can compare it to this. Or you can use industry benchmarking. There are some financial statements of some organizations you see on the internet, especially if they are quoted companies. So definitely you will see their financial statement. So use it as your own benchmark to see if you are doing fine in your working capital or you are doing badly. If you are into banking industry or you are into manufacturing and you have a company that is quoted on the financials, that is quoted on the stock market, so and you can get their financial statement, try to look at their financial statement to your own and see how they are managing their working capital, if you are doing badly or you are doing not so bad. Then we can also look at the transactional data analysis. So you need to prove and quantify improvement potential. That is collection. I think we have explained all this one in details before. Then we can always look at the policy and procedure to review. If you have policy before, you can still review that policy. If your policy on your own organization is for your debtors to pay you in 30 days, that was then. Now that things has changed, now that the things has changed, especially that economy, and we have all these things now, you can change that policy. Talk to your management. See, we can no longer take this to be what? To be 30 days. We need to review this, our days of our receivables. It can now be 20 days. You just need to write to your customers that we have changed our policy and you are fine to go. Then initiative and target selling. Target setting. Define initiative and set improvement targets. You can't be using the same method all this while and you still expecting it to be giving you the same results. No, you have to re-strategize. You need to strategize how to do it better. Then implementation plan and report. Make sure the implementation, you make sure you implement it. Put people in place that are going to implement this particular policy you are putting in place. If you have internal auditor, fine. Let internal auditor implement all this control you put in place. How many days do we say they should pay our money? Is it 30 days or 20 days? If they are not following, sanction them, give them query. When you implement, you must make sure you follow up, and then you report to the management. What is feedback? What are we getting? Are we doing fine from our plan? If we are doing fine, no issue. Please, just a minute. Let me plug my charger. Just few minutes to plug my charger. I think we should be rounding up soon. Okay, so sorry about that. So let's continue with that. Okay, so let's look at this analysis of companies' working capital. So we can all see this is what we can read on ourselves. I mean by ourselves. From here now, you will see this thing here. You can see that we are having years. We have our inventory. We are comparing how many years together. We are comparing 3 years, December 2011 and December 2012 and December 2013. So we are comparing it together. This is how to benchmark. This is how to look at the trend. In 2011, let me ask this question. In 2011, your receivable days or your inventory in 2011, your inventory is what? Is 17 naira or $17 or whatever amount you want to use. But in a nutshell, in 2011 is 17. In 2012 is 16.6. I mean 16.8. Then in 2013 is 20.2. My people, which one are we doing better? Are we doing better in 2013? Or are we doing better in 2012? Or are we doing better in 2011?
2012.
2012. Because
It's
our
better.
inventory increased to 20.2. Okay, that is one aspect. But when you are looking at the working capital aspect and you want to calculate, okay, we want to calculate it. Assuming we have all these figures in percentage now, we can now compare and contrast. Now, like I said, the lower the receivable days, the better. If your receivable is lower, I mean days now, not the actual amount. Before you can get receivable days, you will need to divide inventory divided by the cost of sale multiplied by 365 days, Abi. But we don't have the cost of sales here. That is why we won't be able to prepare the days of receivable. So, however, when the receivable days is increasing, it means you are doing better. Assuming this figure you are seeing now is in days, it means you are doing better in 2012 than every other year because we have 16.8. But because this is a figure as a whole, we can say we are doing better in 2013 because our inventory was high. Though we don't know if you calculate it, the days is better. The same thing receivables, the same thing to accounts payable. So receivable and inventory goes together. The lower the day, the better. Why the accounts payable, the higher the date, the day, the better for the payable. And we can all see this chart on our screen. We can see The color blue here is meant for account receivables. Then the color yellow is for inventory, and the color green is for account payables. Okay, so when you are also presenting to your management, you are advised to use graph. All these directors, CEO, they are not used to figures. So when they see graph, it speaks more to them than seeing all these figures we are talking about. So in a nutshell, let me just summarize this slide because I don't want this thing to go beyond 9 o'clock. The table opposite shows working capital receivable. These figures have been calculated on general balances from 2011 to 2013, advised to us by management. Working capital deteriorated between 2012 to 2013 and stand at 20.5 or 12.8 of non-group sales. At the end December 2013, of which operating working capital was 24.1 million, non-operating working capital is 3.6 million naira. Just look at the calculations, they are simple, and I still want to show you some other things. I hope we'll be able to finish with that period anyway. Maybe I will start jumping some aspect of it now because of our time. So I can just make the slide available to you if possible. So analysis of company data set. So when we are still talking about, you can decide to be doing your working capital every month so that you will start seeing the movement of the working capital and you'll be able to follow them bomber to bomber, if to use the word. Okay, so inventory effectiveness. So we are looking at this example now. We have Dangote Cement, and we can see 2022 and 2021. We also have the inventory aspect. Now, this one we are talking about is what we call benchmarking analysis. So we have two types of companies here. We have Dangote Cement, we have Buha Cement. We have Dangote Cement, we have Buha Cement. We have Dangote Cement, we have Buha Cement. So if you look at the 2022 Dangote Cement, their cost of sales is what? It's 662,890. Then in Buha Cement is 197,944. If you look at the inventory aspects, of Dangote Cement, that is the the dampers, we have 239,563. If you look at the Buha Cement, we have 52,468. Now, to calculate our inventory days, what do we need to do? We will need to divide what they have as a cost of, what they have as the inventory in 2022, divided by the cost of sales in 2022, multiplied by 365 days. If you punch your calculator, you are going to be getting 132 days in 2022 for Dangote. Then in Buha Cement, they'll be having 97 days. My people, who is doing better in working capital between Dangote and Buha? Can you drop it?
Wow.
Buha is doing better. Thank you so much. Because it's taking them, yes, fine. Because Buha is taking lesser time, lesser days to convert that inventory into finished products. Okay, don't let us waste much time here. Let's move on to the next one. The next one is talking about accounting or trade receivable ratios. If you also look at this now, Dangote Cement is having 1.6, Buha is having 360. Their accounts receivable is 45, the 18 for Buha. And we need to calculate. When you calculate, how do you calculate this? You say, you need to, the trade receivable divided by sales. This sales we are talking about here is credit sales, multiplied by 365 days. So after that, you can see that Dangote is having 10 days. and Buha is having 0 days. No, it's they are collecting, it means they are collecting their money immediately. Who is doing better between the two? We can see that
Bua.
it's still Bua. Yes, Bua is still doing better because in inventory days, the lower the period, the better you are doing. The lower the period you are doing. Now, let's look at the last aspect. The last aspect is the account payable. For account payable here, Dangote is 662,890 and Buha is 197,944. Then under the account payable, we have 334. We have 334,899. Then we have for Buha, we have 97,112. And then after calculating their payable days, which is going to be payable divided by cost of sale multiplied by 365 days. So we have 180 days for Dangote. We have 144 for Buha. My people, who is doing fine out of these two people? Out of these two companies? Buha or Dangote?
Dangote.
Dangote, thank you so much. Because Dangote was able to hold the people who are supplying them, and they use that money to run their organization, to run their working capital before bringing it back into organization. So cash conversion is what we call life cycle, operation cycle, operating cycle. That is what we call operating cycle. How you can convert it from cash to inventory, from inventory back to the, so that is what we call operating. And that is what we are just explained just now. Okay, so we are going to look at their next aspects. Let me see how many slides do I have to go, because I want to finish it in 9 o'clock, by 9 o'clock. So what is the objective and key focus items? We look at the working capital improvement, data analysis, procure to pay, forecast to fulfilled, and order to cash. All this we can read all this ourselves. Perform segmentation analysis of customer and vendors, just like what I said. So it's going to be tasky anyway, but you need to analyze all your customer one by one and know your vendors one by one. Review spending by category by payment channel. Review current and historical account receivable, account payable, aging performance. Analyze supplier and customer payment terms and associated trading volumes. If you are going to pay, if you are going to buy higher, I should be able to dance to your tone at least, because you are going to give us more money. Okay, analyze billing and collection process. Compare customer and supply contract terms with actual payment behavior. Analyze value, nature, and cost of disputes invoices. So what normally give you, they said they are going to supply you 5,000. Later, in the next 2 days, they change it to 6,000. And you people now start arguing. I'm not going to pay 6,000, I'm going to pay 5,000. Make sure you identify all the issues. And next time when you are going into that contract, make sure both of you sign the contract so that there won't be any changes in those areas. And you can, if you are the one selling, you can put them in the condition that if you're unable to do the transaction within 5 days, the price will change. All these are very vital in working capital management. Okay, you can also read all this one ourselves. Reports on improvement opportunities, and then make sure you report them to the management so that they will start working on it. All these are this our normal thing we have discussed. You can look at this one, process and policy improvement. Rationalize the client database regularly. Is it yes or no? And the light is like, I have a question. Please kindly send across the slide to us. I will try to send that. If not today, it can be tomorrow. I will try to send. Then risk assessments. All this one, we can just read it ourselves. I think we have done justice to this. So next time I can take my time to actually explain cash flow statement properly. But today we are not explaining cash flow in full. We are explaining cash flow. This thing we are explaining is cash flow, but we are not explaining it in full. So if you want me to explain cash flow, I can actually take that in next webinar. Okay, so I'm going to explain that. Okay, so let's still look at all this one. You can read this yourself without wasting our time. So when you are looking at supply cycle, organization, selection, agreements, invoice monitoring, payment management, reports, and key performance indicators. All this one, we can look at it. You can read them yourself so that you will know what type of policy am I supposed to put in place for me to correct all this working capital. An end-to-end approach allow one to focus on the key of working capital. So value bottom up to change panel, engage the business on a bottom up basis and value the change, measure to improve. That is, establish baseline reporting and metrics early in the program. Attach operational and financial metrics to each change. Communicates the importance, that is, make working capital improvement important to management. Let them understand the purpose of working capital and communicate to them. Most of them are not financially sound. I mean, the accounting terms, they don't know them. They don't really do good in corporate and stuff like that. So you as an accountant, communicate to them, educate them every time so that they will know the purpose of working capital. Integrate with one other priority and embed cash objective into other key change initiative, both existing and new. Thanks so much, sir. Very educating. You're welcome, sir. I'm still. Then sustainable changes. Focus on sustainable changes and not on short-term fixes. Okay. You can read all this one yourself as well. I think we are good to go now. Fine. I was able to end it within that 9 o'clock I was targeting. So now, let's now go back to the question. So if you have any question now, let me now take the question one by one. You can unmute yourself. You can drop the question on the chat box. So next time I can take cash flow proper. If you want me to do that, I don't mind. I can do that one in the next upper month so that we can look at cash flow so that I can correlate with this, what we have done as a continuous learning aspect of it. So the question is, sir, what is the meaning of CFFO? Cash flow from operations and cash flow, free cash flow. How is it calculated and different between the two? Okay, so I believe if you are writing SFM, or if you have done SFM, or if you are about to do SFM, you will be having a particular topic in that SFM, which is talking about free cash flow. And there's a way of calculating that free cash flow. Okay. After all this, they are going to deduct all this depreciation and the light and make sure they get the normal thing. So the free cash flow is talking about you are deducting the non-cash items from it. Just like normal when you are calculating your adjusted tax profit. Okay. Then when you are now looking at the cash flow from operations, you are talking about cash you have been able to generate from the main core operation of the business. Maybe your business is to sell products and is to produce and to sell products. Whatever you generate from the selling of that product is your cash flow from that operation. But peradventure, if you now sell one of your assets, if you sell one of your assets during the year, you are still going to receive cash. You are still going to have inflow. you are still going to have proceed from that particular sales of asset. That kind of sales proceed is not your inflow from your operation because it's not your normal operation. So it's coming from another operation. It's coming from another aspect of organization, but not directly from the activities of organization. And that's the difference between the two. And what I've been doing since morning is basically on cash flow from operation. If you see, that's why we are mentioning receivable, inventory, payable, because these are the three core areas that deals with our what? Our operation in the organization. I believe I've been able to answer that question. Okay, so if you have any other question, let me know. Thanks so much, sir. Very educated. Okay, I think I've done that before. So any question before we move? If there's no question, I have another one material to share with you very quickly. Just to share with you very quickly within 5 minutes. Let me just show you so that we can round up the training. So that we can round up the training. So that we can round up the training. Okay, I have that here now. So it's actually on Excel. So you can also go for that and then calculate how to do your working capital in your office by getting all this information. I'm trying to open the material. At least I still have 2 minutes. I don't want to use more than that particular period. But let me try to open that Excel sheet. I think it's opening. Okay. Okay, so I want to believe you can all see my screen right away. And I'm trying to make it a bit bold for us to see. So this is how to prepare your working capital, monthly working capital analysis. And I believe you can see your screen is sharing. Okay, so I believe you can all see that. So we can see how it's been done. These are the working capital for every month. So you can do it every month, January, February, up to December. So you can do it up to December like that. And what are the items we have? We are talking about inventory. We are talking about inventory, but your inventory can be divided into two. It can either be raw material, working capital, work in progress, finished goods, spare parts, other suppliers. All these are under your inventory. You will separate them like that each month. Then under your trade and other receivables, you can be having your receivables, trade receivables. If you have your prepayment, you put it here. Whatever that is under current asset, apart from inventory, is coming here. Then you also talk about the current tax liability. You're talking about trade payables, payroll benefits payable, dividend payable, other current payable, contract liability provision, income tax, or anything that is under your current tax liability are coming here. So I can as well share this template with you. So whatever you have, then you'll be having your working capital. So your working capital now, whatever you have for your inventory is coming, whatever you have for your receivable is coming, whatever you have as your payable is coming. But that calculation will be another day. We won't be able to do all those calculations now. But I want to believe we have been able to do something tangible. Even if you did not do the calculation, You can go to your management, you can advise them on what to do and what they need to do to improve their working capital. So that working capital, it might look very short. We're only looking at inventory, we're only looking at payables, we're only looking at receivable. But those three things can either make a company or mar the company. If the company is not taking care, if the company is unable to control those things properly, the company can run down if they fail in those three items. My people, ladies and gentlemen, this is where I'm going to stop. If you have any other thing like comments or question or whatever, I'm going to leave that room within 1 minute. If you have anything to say, let us know. Anything like whatever you want to say. We are unable to get there
Just
anyway.
say thank you for your time.
Okay, sir. You are welcome.
Thank you for your time, your sacrifice.
All right. Thank you, sir. You're welcome, sir. Okay, so since we don't have question, let me still wait like 10 seconds. Since there's no question, just 10 minutes. I mean 10 seconds, sorry. If you have anything within 10 seconds, so I can plan to do the calculation next time so that we can see the cash flow in full flesh. Okay, so thank you so much for attending, and we'll see again when we see.